Hey guys, it's JP Invest, and today we're going to be updating you guys about the CPI and what that means for the market. So today, November 14th, 2023, the CPI was released. It was very good. It came in at 3.2, and if you guys want to follow along or kind of just follow these stats by yourself or stay up to date if you guys are watching this video later and see what the stats are now. It's U.S. Bureau of Labor Statistics, and you're just going to Google that, or you can Google CPI, and it'll be like the first or second one popping up. And if you guys go right down on this, you're going to go down to the charts, click Read More, click Next, and this will be your overall chart showing you just the overall CPI. And that'll show you that 3.2 in October. And the month before that, in September, is up in 3.7, which was reaccelerating a little bit, which had us a little bit scared. And the markets dumped off a little bit because of this, because they were thinking that potentially we could have a big bump up like this or something like that, where inflation starts to kick back up, and then they're going to have to keep raising interest rates. If we hop over to the 10-year, interest rates are still, or the 10-year is still going down, which is what we like to see. This is going to be big things that are going to push more money into the equity markets and out of the bond markets. This is because currently you can just get a 4.463% yield on a 10-year, and that just ticked down a little bit more. That's what we like to see. The lower this goes, the more incentive people have to take risk in the market and get ready for more of a bull market and like try to get a higher return than that. If we look at the stock market right now, and we just go over to VU, which is just going to be the S&P 500, today it's having a heck of a day at, oh boy, it's taking a second, sorry, 1.81%, which is a very, very big day for a index like the S&P 500. This is because with the interest rates, or not interest rates, the inflation rates coming down, disinflation, not deflation, disinflation, because interest rates are just slowing. Stuff is still getting more expensive. Not deflation would be when things are coming down in price. Things are still getting more expensive, but they're just going up at a slower rate. And we wanted that rate to be around 2 is the rate that we're shooting for. So with these rates coming down, that's giving the Fed more incentive to stop raising interest rates, which they did not raise interest rates last month, and it's going to give them more incentive to even maybe lower interest rates because their rates are going to be too high and they're going to be restricting the economy, which they don't want to restrict the economy too much where it pushes us into a recession, but they don't want it too loose where we get pushed back into high inflation and stuff like that. So it's kind of a balancing act. But with this good news, it's looking like the market's thinking that we might be out of the clear and now looking forward into maybe not having more interest rates, and we're looking into when are they going to be lowering interest rates. And I have many holdings that are going to benefit a lot when the interest rates come down, like all my real estate, ARE, CCI, and things like Duke, which have a higher interest rate, dividend. Anything with a high dividend, I think is going to have a really good return in 2024 or 2025 when they start lowering that interest rate on those treasuries, because people are going to want that inflow of cash. The people that want income like that and stable income are going to want that still, but they're going to have to go to stocks like Duke, CCI, Crown Castle, and SLG, things like that. They're going to have to go to these REITs. They're going to have to go to these utilities. They're going to have to go to these dividend aristocrats that just have consistently been able to pay a strong dividend, but they just don't want to take the risk right now because of that high treasury yield. And this has been shown, let me just hop into ARE real quick, up 10% today, because now they know they're not going to have to raise these rates crazy amount. Last time they were talking about raising rates, that is when we took a dump from like 120s down to the 91s. So I think this company has no underlying problems. As you can see, the earnings just keep going up and up and up stably, very slowly, but stably. That's like what it is. It's a stable, strong, growing company. It's not going to be your crazy, fast growing like Palantir and stuff like that. But that's not what this investment's for. This is for more of a return play for when interest rates come down. And I'm going to be getting a great dividend until then. And then I'm going to keep reinvesting it at these lower prices, getting me a better yield on total return. Well, this has been my short update on the CPI numbers, and honestly, I think the CPI numbers are looking great in the future, and I'm hoping with energy down 4.5% and housing up, which negated pretty much that down on the energy, next month, hopefully, the housing starts to correct, and we get that maybe in that 2.9 CPI number, which could be very beneficial for the Santa Claus rally that a lot of us are looking for and hoping for. Thanks for watching. This has been JP Invests, and if you guys have any questions or comments, make sure to put them down below and make sure to hit that like button. And thank you so much. Have a good day.